Welcome to Invest with Neko.
Please like and subscribe to our YouTube channel.
Welcome to the Neko podcast.
Today, the stock market.
How does it actually work? It's just about buying and selling.
All right,
let's dive in.
2020, like 1/3 of the entire global stock market's value just vanished.
Yeah, in just 33 days. It was wild.
43 days. I mean, driven by just absolute fear of the unknown during those early days of the COVID pandemic.
Right.
Trillions of dollars simply evaporated, just gone.
Completely gone.
But then, something incredible happened. Within 5 months, the market had fully recovered every single penny.
Yeah.
And by the end of the year, it was actually hitting new all-time highs.
Yeah.
So I guess the question is, how does a machine that can destroy and create wealth on such a massive scale actually work?
Well, it is a remarkable system, and it's heavily misunderstood by a lot of people.
Oh, for sure.
Because the financial media, they tend to thrive on complexity, right?
Yeah.
And urgency. They frame the market as either this chaotic casino or some terrifying roller coaster.
Yeah, flashing red and green lights everywhere.
Exactly. Which keeps people glued to their screens, but it doesn't actually explain the underlying mechanics of what's happening.
Which brings us to the fascinating stack of beginner investing guides, historical market data, and behavioral economic research you sent over for today's deep dive.
I was excited for this one.
Yeah, our mission today is very specific. We are going to extract the core insights from these sources, strip away all that intimidating financial jargon, and just explain how the stock market works at its absolute simplest.
Love it.
We're really looking at this from the perspective of someone who has never invested a dime before. Someone who just wants to understand the fundamental architecture of building long-term wealth.
Building that foundation is so critical because when you peer underneath all those flashing numbers on the screen, the stock market isn't a secret society for Wall Street insiders.
Yes.
It's simply a marketplace. That's all it is. And understanding the plumbing of that marketplace is really the most reliable way to secure your financial future.
Okay, let's unpack this, starting with the absolute basics.
Yeah.
What exactly is a stock? When someone says, I own stock in a company, what legal or physical reality does that actually represent?
It sounds super abstract, right? Especially today when literally everything is digital on your phone. But it's actually a remarkably literal concept.
Yeah.
A stock, which is commonly referred to as a share, is simply a tiny piece of ownership in a business.
A piece of ownership.
That is the entire definition. You are buying a fractional ownership stake in a real, living, breathing corporation.
Wow.
Yeah, you become a part owner, you hold a legal claim to a fraction of their assets and a fraction of their earnings.
So it's not just like a digital number moving up and down on a brokerage app.
Not at all. I mean, think about massive global corporations like Apple or Microsoft or Amazon.
Right.
If you buy just one single share of Apple, you officially own a microscopic fraction of that company.
That's crazy to think about.
It is. You legally own a sliver of their physical factories, their software patents, their massive cash reserves, and, the future profits from every new device they sell.
Oh, wow.
If the company were to be liquidated tomorrow and all its debts paid off,
Yeah.
you would be legally entitled to your microscopic share of whatever cash was left over.
And when you look up these companies to buy that tiny piece, the sources point out that you use what's called a ticker, right?
Yes, exactly.
And a ticker symbol is just is the shorthand abbreviation you see on trading screens. So instead of typing out the whole word Apple, you'd look up the ticker AAPL.
Right.
Or for Microsoft, it's MSFT. It kind of acts like a unique barcode for the company, so you can track its entire public history.
Yeah, the ticker system just ensures there's zero ambiguity about what you're buying.
Makes sense.
It's a standardized identifier so that, a buyer in Tokyo and a seller in New York are talking about the exact same asset.
I try to conceptualize this on a more local scale. Like buying a stock is essentially like buying a tiny slice of a highly successful local bakery.
That's a great way to look at it.
Let's say your friend opens a bakery. Business is booming, and you buy a 10% stake in it. If they open 3 new locations across town, the total fundamental value of the bakery goes way up.
Exactly.
And because you own 10%, the value of your specific slice goes way up too.
Right, your piece of the pie gets more valuable.
But here's where I have to push back on the premise a bit.
Okay, let's hear it.
If a company like Apple or that local bakery is already incredibly successful in printing money, why would they ever sell pieces of themselves to the public?
Right.
Why invite millions of strangers to share in all those profits?
That is basically the core question of corporate finance.
Okay.
And the answer comes down to the aggressive need for capital. Even highly successful companies require massive amounts of cash to fund their next phase of growth.
Got it.
Let's stick with your bakery example. Suppose they want to build a $50 million state-of-the-art commercial kitchen to distribute their goods nationwide.
Okay, that's a big step up.
Huge step. So they could go to a bank and take out a massive loan, but debt is a heavy burden, you know? They have to pay that money back on a strict schedule with interest, regardless of whether their new expansion actually succeeds or fails.
Yeah, that's a lot of risk.
It is. Debt really limits their flexibility.
But if they sell stock, they don't have to pay it back.
Correct. They opt for a different route called an initial public offering, or IPO.
An IPO.
Yeah. They offer to sell a portion of the company's equity to the public in exchange for cash. By selling stock, the company raises the millions or billions it needs for massive projects without taking on a single dollar of debt.
Like building a new semiconductor factory or an AI research division.
Exactly. The trade-off is just that they are giving up a percentage of their future profits.
Wait, if a company IPOs to avoid bank debt, aren't they basically just taking on a totally different kind of burden?
How you mean?
Well, now the founders have to answer to thousands of angry shareholders every quarter who demand to see growth.
They absolutely are. Being a public company brings immense regulatory scrutiny and, like you said, huge pressure to perform every 90 days.
Yeah, that sounds stressful.
Oh, definitely. But for a company aiming for global dominance, the ability to raise billions of dollars of debt-free capital in a single day,
Right.
that outweighs the headache of quarterly earnings reports. The people who buy those initial shares provide the fuel, and in exchange, they get a seat on the rocket ship.
Okay, so they sell these shares to raise capital, and now I own one. How does that digital share actually put money in my pocket?
Great question.
Because holding a certificate that says I own a millionth of a warehouse doesn't exactly pay my grocery bill.
It all comes down to two specific mechanisms: capital gains and dividends.
Okay, capital gains makes intuitive sense. That is the classic model of buying an asset, letting it appreciate, and selling it to someone else.
Exactly.
I buy a share for $50. The company builds that new factory. The underlying business is now fundamentally worth more, so the share becomes worth $100. I sell it, and the $50 profit is my capital gain.
Spot on. That's capital gains.
But what about dividends? How does that mechanism work?
Dividends are direct cash payments that a company sends to its shareholders out of its quarterly profits.
Really? Just cash?
Just cash. Think of it as your cut of the business's earnings. Usually, it's deposited directly into your brokerage account every 3 months.
Oh, wow.
If the company makes a profit, the board of directors can vote to take a portion of that cash and simply hand it out to the people who own the stock.
But the sources specify that not all companies pay them. Why would a profitable company refuse to hand out a dividend?
Because of the strategic choice between income and growth.
Okay.
When a company makes $1 billion in profit, they have to decide the most efficient way to use it. Older, heavily established companies, think of like utility companies or legacy consumer brands.
All right, companies that have been around forever.
Yeah. They often pay high dividends because they don't have massive rapid growth opportunities left. They've already saturated their markets. So the best way to reward their investors is simply to hand them the cash.
Whereas a younger tech company would want to keep the cash to build the next big thing.
Exactly. A company like Amazon famously avoided paying dividends for decades.
Oh, really?
Yeah. Their argument to shareholders was essentially, if we give you this cash, you'll just have to pay taxes on it right now. But if you let us keep it, we will reinvest it into building an entirely new industry like cloud computing, which will drive the stock price up exponentially.
Okay, that makes sense.
And this brings up a critical point about tax efficiency. Dividends trigger a taxable event the year you receive them.
Right, because it's income.
Exactly. Capital gains, on the other hand, compound tax deferred. You only pay taxes on the growth when you finally decide to sell the stock years down the line.
So I'm either getting paid a cash income along the way, or I'm deferring my taxes while the underlying value of the company aggressively grows.
What's fascinating here is how you can effectively merge these two paths to build a huge snowball effect.
How so?
By using a mechanism called a DRP, which stands for a dividend reinvestment plan.
Okay, continue.
Instead of taking that quarterly dividend cash and transferring it to your checking account, a DRP tells your brokerage to automatically use that cash to buy you more fractions of a share of that same stock.
Oh, so my tiny slice of the company generates cash,
Right.
which automatically buys me another tiny slice, which will then generate slightly more cash next quarter.
Yes, and it requires zero manual effort.
That's brilliant.
By year 10, your dividends are buying whole new shares for you. By the time you retire, your money has literally been working in the background for decades to acquire more income-producing assets.
That is so cool. Okay, so if a company decides to reinvest its cash to build a new factory, the company is fundamentally worth more in the real world. But how does that physical factory translate into the digital stock price moving up on my screen in real time? Like, what is actually setting the price second by second?
It is the purest execution of basic economics, supply and demand.
Supply and demand.
But in modern markets, it happens at lightning speed.
Okay.
If a company announces a breakthrough product, suddenly more people want to buy the stock than there are current owners willing to sell it.
Right. Demand goes up.
Exactly. And to entice the current owners to part with their shares, the buyers have to offer a higher price. The moment a seller accepts that higher price, the stock price updates on the screen.
So the price is just a history of trades?
Exactly. It's simply a record of the last agreed-upon transaction.
Okay.
Conversely, if a company reports a massive lawsuit, current owners want to sell, but nobody wants to buy. The sellers have to continually drop their asking price until they finally find someone willing to take the risk.
The sources actually outline the mechanics of this haggling process using the terms bid and ask.
Yes. The bid is the maximum price a buyer is currently willing to pay.
Okay.
And the ask is the minimum price a seller is currently willing to accept.
It functions exactly like haggling over a used car then.
Pretty much.
If you're the buyer, you want to pay as little as possible. You offer, say, $10,000. That's your bid.
Right.
The seller wants as much as possible, so they ask for $12,000. That's their ask. The actual market price only exists when you both give a little ground and meet somewhere in the middle.
Exactly.
But in the stock market, you aren't waiting days to negotiate. You click a button, and the trade happens instantly.
Right?
How is there always someone waiting to take the other side of my trade at the exact second I want to buy or sell?
If we connect this to the bigger picture, the answer is a specialized group of financial institutions known as market makers.
Market makers.
Yeah. Their entire business model is to constantly, quote, both bid and ask prices for thousands of stocks simultaneously.
Okay.
They stand ready to buy from you or sell to you at any given millisecond.
But why would they take on that risk? What do they get out of acting as the middleman for millions of trades?
They profit from the gap between the bid and the ask, which is known as the spread.
The spread, okay.
Let's say a market maker quotes a bid of $10 and an ask of $10.02.
Right.
They buy a share from a frantic seller for $10, and a millisecond later, they sell it to an eager buyer for $10.02.
So they just made 2 cents.
Exactly. They only made 2 pennies on the transaction, but through algorithmic, high-frequency trading, they do this millions of times a day.
Wow, that adds up fast.
It does, and their profit incentive is what creates liquidity.
And liquidity just means that you or I can convert our shares into cash immediately. We aren't stuck putting a for sale sign on our stock and waiting 6 months for a buyer like we would if we were trying to sell a house.
Precisely. Liquidity is the lifeblood of the market. It gives everyday investors the confidence to put their savings into these assets, knowing they can access their capital instantly if an emergency arises.
That makes a lot of sense. That perfectly explains how a single stock moves based on supply, demand, and these algorithmic middlemen.
Yeah.
But when you look at the broader financial news, they rarely focus on a single company. They say things like, the market is down today. How do you measure the collective mood of thousands of entirely different companies all at once?
You use a measurement tool called an index.
An index.
An index is essentially a mathematical basket of stocks used to gauge the performance of a specific segment of the economy. Instead of trying to track 3,000 individual moving pieces, you just track the average performance of the basket.
The 2 heavyweights mentioned in all these guides are the S&P 500 and the Nasdaq.
Yes, the S&P 500 is the ultimate benchmark.
Okay.
It is a basket of the 500 largest publicly traded companies in the United States, spanning every sector: healthcare, energy, technology, industrials, you name it.
So it's very diverse.
Very. Because it represents such a massive, diversified cross-section of the American economy, when financial professionals say the market, they are almost exclusively referring to the S&P 500.
Got it. What about the Nasdaq?
The Nasdaq is a separate index that is heavily weighted toward technology and biotechnology companies.
You know, I noticed the sources mentioned weighting. It's not just a simple average of 500 companies, right?
Right. The S&P 500 is market capitalization weighted.
What does that mean?
That means the bigger the company, the more influence it has on the basket's final score. Think of it like a grocery bill.
Okay.
If the price of a $50 steak goes up by 10%, it impacts your total bill significantly.
Right.
If the price of a $1 pack of gum goes up by 10%, you barely notice.
That's a great analogy.
In the S&P 500, massive companies like Apple or Microsoft are the stake. A 5% drop in their stock price will drag the whole index down much harder than a 5% drop in the smallest company on the list.
Here's where it gets really interesting, though. If an index is just a reflection of the millions of human buyers and sellers making decisions, and human beings are ultimately driven by psychology,
Oh, absolutely.
that means the market itself is deeply susceptible to emotion. Specifically, The emotion of fear.
You hit the nail on the head. While the long-term, multi-decade trajectory of the stock market is driven by actual corporate earnings and gross domestic product, the short-term, day-to-day movements are almost entirely dictated by human psychology.
Which brings us back to the stark reality we discussed at the top of the show, the 2020 COVID crash.
Yes.
The sheer terror of a global shutdown broke the normal mechanics of the market. Institutional algorithms and retail investors alike just panicked.
Completely panicked.
The S&P 500 plummeted 34% in a mere 33 days. It felt like the financial system was collapsing.
It was one of the most violent contractions in the history of global finance.
Yeah.
If you were a new investor watching your retirement account, seeing a third of your life savings evaporate in a month triggers a very primal survival instinct.
The natural reaction is to hit the sell button, pull whatever cash you have left out of the market, and hide it under a mattress until the world makes sense again.
And millions of people did exactly that.
Wow.
But that instinct is the most destructive thing an investor can do. They fell into a well-documented psychological trap called loss aversion bias.
Loss aversion bias.
Yeah. Humans feel the pain of a financial loss about twice as intensely as they feel the joy of an equivalent gain.
That's so interesting.
By panic selling at the bottom of the crash, those investors took a temporary paper loss and locked it in as a permanent loss of real purchasing power.
Because, as the historical data showed, the market recovered entirely in just 5 months.
Exactly.
Wow.
The investors who managed their emotions and held onto their assets recovered everything. And the investors who saw the crash as a clearance sale and aggressively bought more shares of fundamentally sound companies while they were cheap, they ended up accelerating their wealth by years.
It's just like Warren Buffett famously advises, right?
Mm.
Be fearful when others are greedy, and greedy when others are fearful.
Words to live by in investing.
So if you can stomach the volatility, ignore the panic, and not hit the sell button when the news is screaming that the sky is falling.
Yeah.
What is the actual reward for enduring the roller coaster?
The reward is the most powerful wealth engine ever devised. Compounding returns over long time horizons.
Compounding returns.
If you look at the historical data spanning the last century, a century that included world wars, recessions, dot-com bubbles, and global pandemic.
Yeah, a lot of chaos.
Right. The S&P 500 has still delivered an average annualized return of roughly 10%.
10%. So what does this all mean? Let's take that 10% average and apply it to some very basic math for you listening, because this is the moment where the mechanics finally translate into real-world impact.
Let's do it.
If you invest just $50 a month, which is honestly less than a lot of us spend on coffee or streaming subscriptions,
So easily.
and you do it consistently for 40 years, assuming that historical 10% return, your money grows to roughly $265,000.
You really need to pause and look closely at those numbers.
Yeah.
Out of that $265,000, you only contributed $24,000 out of your own pocket over those 4 decades.
Wait, really? Just $24,000?
Just $24,000. The underlying businesses you owned and the compounding effect of the market generated the other $240,000 for you.
That is mind-blowing.
Your initial capital earned a profit, and then those profits began earning their own profits.
This raises an important question. If the math is that objectively clear, and broad index funds make it so easy to own a diversified slice of the economy, why do so many people refuse to participate?
There are really 2 major mental roadblocks. First, people assume investing is an exclusive club that requires thousands of dollars just to walk through the door.
Right, like you need to be rich to start.
Exactly. But as your $50 example proves, it is about consistency over time, not massive upfront capital.
Makes sense. What's the second roadblock?
Second, people suffer from the illusion that keeping cash in a standard savings account is the prudent, safe option.
Because the number never goes down.
Right. It feels incredibly safe to log into a bank app and see the exact same balance sitting there year after year.
Yeah, I get that.
But it's actually shrinking.
Because of inflation.
Because of inflation. In the United States, inflation historically averages around 3% a year.
Okay.
That means the actual cost of living, your rent, your groceries, healthcare increases by 3% annually.
Right.
If you have $10,000 sitting in a checking account earning 0 interest, a year from now it might still say $10,000, but its purchasing power has dropped.
You can buy less stuff with it.
Exactly. A decade later, that cash buys significantly less real-world goods. Holding uninvested cash is a guaranteed slow loss of wealth.
So the cost of sitting on the sidelines is actually brutal.
It is the single most expensive mistake a person can make. The mathematical reality of compounding means that a 10-year head start in the market is often worth more than the next 30 years of aggressive saving combined.
Wow.
You have to put your capital to work as early as possible so it has the runway to snowball.
Well, to wrap this all up, let's revisit our core mission for this deep dive. We wanted to strip away the noise of the financial media and look at the engine underneath.
Yeah.
The stock market is not a shadowy casino. It is not an exclusive club. It exists for one incredibly simple structural reason.
Right.
It connects companies that require capital to build, innovate, and expand with everyday people who need a reliable mechanism to grow their wealth over a lifetime.
Exactly.
You provide the capital, and in exchange, you legally own a piece of their success. That is the entire game.
It truly is. And as you process all this and look toward your own financial future, I want to leave you with a final thought drawn directly from the behavioral research we reviewed today.
Okay.
Studies show that in highly speculative, volatile markets, a tiny minority of informed participants, sometimes as few as 5%, can trigger a herd mentality that ends up dictating the panicked actions of the other 95%.
The 95% just follow along blindly.
Exactly. The next time you see the market taking a sudden dive and you feel that visceral, sickening urge to sell everything just because the talking heads on television are doing it, you need to ask yourself a question.
What's that?
Are you going to be part of the 95% being blindly led by the herd? Or are you going to be the 5% who understand the underlying mechanics, hold steady, and protect your future?
That's a wrap for today. See you tomorrow with another lesson.
Don't forget to like and subscribe. See you then.
The information provided on this podcast is for educational and informational purposes only and should not be considered financial, investment, or legal advice. I am not a financial advisor, and the strategies or assets discussed may not be suitable for your personal financial situation. Investing involves risk, including the loss of principal. You should always consult with a licensed professional before making any financial decisions.